Okay, the next topic is balanced scorecard. Now, this is a very important topic in your F5 exam. Uh, it is tested very frequently in your theoretical questions. It is balanced scorecard. We talk about the non-financial performance indicators. We call them, non-financial performance indicators, which otherwise you call them NFPIs. So there are NFPIs, non-financial performance indicators. One of the issues with the financial performance indicators, like you do also in your F3 or F7, your ratio analysis or your variances, they are very rigid. They are very, they're inflexible. Like if you talk about ratio analysis, if you remember, you did ratio analysis in your financial accounting and you do variance analysis in your management accounting. And they are very typical of them. Like material, labor, overhead, sales mix, overhead and efficiency ratios, usage ratios, usage variances and price variances. Then you had your liquidity ratios, you had your profitability ratios, and you had your efficiency ratios, etc. All of them are very rigid, but businesses, they are in variety. I mean, there is a restaurant, there is an insurance company, there is a steel manufacturing business, there is an airline, there is a bank. Now, there is a wide variety of businesses. Now, how do you measure the performance of such wide variety of businesses given one set of tools? Like I give you 10 ratios or I give you 10 variances, and you start applying the same type of ratios and the same kind of variances to all of these businesses, which definitely are not the same in nature. So one of the disadvantages of financial performance measurement is that the financial performance measures, they are very rigid, they are not adaptable, they are not flexible depending on the nature of business. And then we also discussed that these financial performance measures, they talk about past, they talk about internal things, they only talk about numbers, and they do not reflect the future. Now comes non-financial performance indicators. Non-financial performance indicators, they are actually they have external focus. So we are not talking only about ourselves, we are seeing the business from outside perspective. External focus, they reflect on future. And I will give you examples, how do they reflect on future. And they are flexible, which means that you can, design based on your business, which you can design based on your business. So external focus, customer satisfaction, company image, product reliability, product image, etc. Future, like for example, if I tell you that your financial indicators are very good, you just made a 10% increase in net profit, probably you just made $10 million profit. If you make $10 million profit in 2019, does it guarantee that 2020 you will again make 10 million or more? The answer is no. If you make in 2019 $10 million, it does not necessarily mean that in future you will also make this much or more. Now, if I tell you that in 2019, your profit is, or your profit was, let's say, I don't know, let's call one number, $10 million. But at the same time, I tell you that customer satisfaction has gone down and product reliability has gone down. Now, this is, for example, 15% more than last year. So if you see only this one statement, the financial thing, that in 2019, your profit was $10 million, which is 15% more than the last year, probably you are happy. Oh, we made good profit as compared to the last year. But then when I give you this information, you need to get worried. because it looks like that maybe you did something in business which has resulted in making you the profit, but your customers are not happy with that. Maybe you compromised on quality of product, maybe you compromised on service, maybe you compromised on warranty, maybe you compromised somewhere, because product reliability has gone down and customer satisfaction has gone down. So there is some serious issue in the product quality, in the production process, and there is some serious issue in the customer service issue. And then I can say that 2020 is not going to be a good year, okay, based on this thing. So this does not tell me about future, but this part tells me or gives me some idea what is going to happen in future. Because if customers are not happy, product reliability is going down, product sales will go down in future. So balance scorecard is a measure, and through balance scorecard, what we do, we try to measure the non-financial performance of a business. So we call them NFPIs, non-financial performance indicators. And I said that this is flexible and each business can design according to their own needs. For example, if you talk about McDonald's, their core, their critical process, their critical process is delivery time. When people go to McDonald's, everybody is expecting a quick, fast delivery. So McDonald's would set up some, their CSF, critical success factors, and then their KPIs. You've got, you have your target, and to achieve your target or achieve your goal, you have your KPIs, you have your critical success factors, and to achieve those critical success factors, you set your KPIs. So you have a KPI, key performance indicator, that any customer which places an order should be delivered food within 7 minutes. So this is your key performance indicator, which is in place to make sure that your critical success factor of quick delivery is achieved. So if you miss on this KPI, so we need to measure our performance, this KPI on daily basis, on weekly basis, that how quickly are we delivering food? Are we achieving our goal or target of 7 minutes or not? Because if we are not meeting it, it means that this critical success factor, which we believe that in our business being McDonald's, quick delivery is one of the critical success factors. So if it is not being achieved, this will not be achieved. If this will not be achieved, your targets will not be achieved. So we designed the system, like I said, flexible. A bank will design according to its own need. For example, you are an insurance company. What about people coming in and making claims, and in how many days do you accept the claims, and how many days do you deliver the claims? Or probably you talk about, if you are manufacturing something, you talk about the rejection rates. If you are FedEx, if you are DHL, you know that correct delivery. DHL and FedEx, it's not just about the time, like 72 hours they deliver, but the thing is also that how many parcels do you deliver at the wrong address? How many times do you make wrong deliveries? So you know that proper delivery, in not only in proper time but in proper place, is important. That's critical success factor. And you start monitoring that. So non-financial performance indicators, it's not just about quick ratio, current ratio, asset utilization ratio. It's about setting your business processes and then monitoring them and seeing the non-financial performance of your business. And non-financial performance of the business, that will, how to say, predict your future. So balance scorecard. We start the topic now. So management translates its strategy into performance measures that employees understand and accept. And we are talking about performance measures. And if you pay attention, this is the financial performance measure. This is how our shareholders, they see us. Let me write it down here. Let me write down some statements here so that we are clear. We say that how shareholders, they see us. And this is your financial performance. This is just, so we said that any business, it has four sets of performance measures. 4 sets of performance measure. This one is financial. And actually, all others are non-financial. All others are non-financial. So only one set is financial. And this one where you do your ratio analysis, or maybe you do your variance analysis. Here you are doing your ratio and your variance analysis, which you call it financial performance. Then customers, how do customers see us? How do our customers see us? So asking about your customers, I mean, when you go to any restaurant or you go to some hotel, end of your, trip, within your hotel room, they leave a card where you put your feedback. They ask you about that, how was your stay, how was the service, how was the price, the room service, the food and the cleaning and others. And there are some 10, 12 measures. Those 10 or 12 questions are actually their KPIs, which they consider will ultimately transform their into their critical success factors. So those questions are not just somebody has put them right something from the air. They are very well thought questions, because these are the questions on which they collect data, because they consider that these questions and answer to these questions will actually positively or negatively impact their performance and their future. So first, how shareholders they see us, we give them our profitability ratios, our gearing ratios, our liquidity ratios, and we put them on one side. Then we talk about customers. How do customers they see us? I mean, sometimes people are buying from you, but they are not happy. They're just buying because they don't have any other option. Okay. So as long as your sales are good, you should not be, very, how to say, relaxed or silent that everything is good. Maybe everything is not good. Customers are buying from you because they don't have any other option. You are close, you are near, you are probably better than the existing ones, but still customers are not happy because you do have some issues. So you definitely need to ask your customers. Even though people are buying, they may not be happy. So you need to ask what are their issues and how do they, what feedback do they give? And then we talk about learning and growth. It's very, very, very important that businesses, they learn and they grow. And you should remember that individuals, they learn, and businesses learn. It's like individual learning and corporate learning. So individual learning is in place. Companies are investing and spending money on their staff, investing and spending money on their people to train them, to make them better resources, more knowledgeable resources, and more efficient resources, because a better team will lead you to the growth. When you have in a company people who are old fashioned, less acquainted with the modern knowledge, less acquainted with the modern business practices, such businesses, they are not sustainable in today's world. So companies are spending literally hundreds of thousands and even millions of dollars on training of their staff. And then there's a corporate learning. When these people they come in, they introduce better systems. They the work which is done by a more educated, more efficient team. And internal business processes. This is the fourth area on which we need to focus. Which areas? Internal business processes. This is that area where I spoke about, if you remember, your critical success factor. Like for McDonald's, I said that delivery time of food is one important factor. So which internal business processes are crucial or critical to the success of the business? Those internal business processes should be identified, and those should be improved, and the organization should be working on collecting the information about those processes, if we are meeting or achieving or improving those factors or not. So these are four dimensions of balanced scorecard. First one is financial, and all the three other are non-financial. And within non-financial, we say that how do our customers they see us? We get their feedback, we get their opinion. And learning and growth. Are we growing through learning or not? Are we spending money? Are we training on our people? Are we improving the quality of our human resource? Because you should remember that end of the day, what makes difference between businesses is the management and the people. I'm sure that you people have noticed this thing. There are two banks in your local environment, and both of the banks, they are almost of the same size, and they probably provide the same products and services, the same banking services and products they provide. But one bank you like, the other one you do not. And the same goes for a restaurant. Most of the restaurants, they provide almost the same food. Many of them, they provide the same food. You don't go and you see something very unusual. It's about how do you manage the business. It's about how do you run the business. Whenever you see a successful growing company, you will find a good team behind that. And whenever you see an unsuccessful losing business, there is a bad team in that business. So management and the team and the staff, they play a crucial role. And how much are you growing? Now, I give you one example. We have experienced this thing many times in our life, and I'm sure you have said this thing, like you yourself have given this expression. Let me tell you that expression, because I felt that thing many times, and I'm sure that you also. For example, I said that this business, some time ago it was very good. Now as they have grown big, now they don't care for their customers. Now it's not the same one. They were good before, now they are not doing good. It has happened with your telecom operators. It has happened with your many other businesses. You always refer to that, in past they were very good. Now they are not as good as they were. You know what happened? Because they had a team which was capable of managing this much size of business. And that team was really good, and they were doing good. And it is the same team. But then what happens that the business, it became bigger. That team was so good that it made the business successful, and the business expands. And when the business expanded, it became bigger. Now, this team had capacity to manage this level of business, okay? The size of the business has grown, but the capacity and capability of the management team is the same. So they were very good in managing a medium size or a small size business, but they are not trained, or they were not trained to manage a large scale business. And then the business starts going down, and people, they start coming in with complaints that this business has grown big and now it is not doing as good as it was doing in past. Because if the business is growing, the team should also grow, not in terms of numbers, but in terms of quality. And you should remember that improved quality of human resource means better decisions, better processes, and better processes means better products and services, and better products and services means better customer satisfaction. And of course, internal business processes, I spoke before. So these are the 4 dimensions of balanced scorecard. This balanced scorecard, I remember that now it is not going to come for 15-mark question, because your exam structure has changed in last 3-4 years. But until 2014, balanced scorecard used to come like for a 12-mark question in exam, a theoretical question which could come for 12 or 15 marks. So it's a very important topic because we are talking about performance measurement and performance management. And when you talk about performance measurement and performance management, so non-financial performance is a big issue, and non-financial balanced scorecard. And one more model is building block. So 2 models are there, building block and balanced scorecard. Balanced scorecard I'm doing now, building blocks I will do next. So what is the philosophy behind this balanced scorecard? In balanced scorecard, you say that learning improves business processes. Improved business processes improve customer satisfaction, and improving customer satisfaction, it improves financial results. So don't just jump onto making profit, okay? Don't see on working on making profits. Just focus on learning. When people are learning and corporate companies are learning, so learning improves the business processes. automatically. And improved business processes will improve the customer satisfaction, and profit will be the result. And improved customer satisfaction will be translated into better financial results. This is the, how to say, the modern approach of making money. The traditional approach of making money was you were thinking about dollars, how to make dollars, how to make dollars, and you were thinking about, cutting cost and others and other things. But in maybe, producing more, bringing down the fixed cost, stuff like that, that is there. I'm not against that. But the modern business approach is that you should start the process from here. This should be step one. This is step two. And profits will be ultimately coming in as a result of step two. So this is step one, step two, and step three. This is how you move.